Welcome to the simpliHOM podcast, where we educate, inspire, and entertain real estate entrepreneurs seeking a casual and practical podcast. We're here to simplify your life and business.
You can find growth anywhere. And as long as you have an open mind and take those opportunities to learn, then you're going to grow from it.
The easiest thing too is just always being in your zone of genius. What you are passionate about and are good at.
The mindset shift is drastic when you're thinking of I am this person as opposed to I want to become or one day I will be is huge.
I feel like a lot of real estate companies have been putting a focus on themselves, basically. Recently, we've been putting it on the agents, and that's when our socials have been doing the best. It's become really personal, and we've gotten a lot more traction.
What's up? What's up? Welcome back to the simpliHOM podcast. I am your host on this one, Sean Miku, CEO and founder of simpliHOM. And pardon my voice, I decided to play tag with allergies and perhaps sinus infection. So I sound like crap. So I hope you guys still enjoy listening. I'm joined here today by David Lippe, who is a lender with SWBC and has been doing this for quite a while. Since 1996 is his license date. I was seven. Not to age you or anything, but I'll age me. So welcome to the show. Thank you for joining. Looking forward to hearing everything you have to share and talk with the craziness of this market. We've seen interest rates to like skyrocket, but
it's crazy.
Go from what to what and when?
So over Christmas, I was quoting interest rates in the high twos, around 2.875, maybe to low threes, right around 3%.
Yeah.
And today, right before this, we're quoting about 4.75.
Good.
So 4.8. So 2 full percent rise in just 90 days.
Yeah. So have you seen that before?
No. And yeah, it's pretty historic.
Okay. So do you think it's here to stay? Or do you think it's, I read something yesterday from the NAR economist, Lawrence Yu, who said something along the lines of they're not 100% sure that the interest rate hike is here to stay, or if it's just kind of a volatility that we're seeing right now to curb the inflation. What are your thoughts?
So again, historically, the fact that interest rates are, let's just say the high fours right now, that's still an amazing interest rate historically.
Yeah.
So people got really used to interest rates in the, threes or twos.
Twos, yeah.
And so, for the past 2 years during COVID, that's why rates went down so low. Actually right now, they are almost exactly what they were right before COVID. And so
oh, really?
Just forget
God, I forgot about that.
I know. They were in the mid fours around Christmas 2019. Yeah.
Wow.
So back to your question, are they here to stay? They should be. This is about where they should be.
Where they should be.
And so I think that, for the rest of the year, we should get used to a 4 in front of the interest rate, 4.5 to 5%.
Yeah. And are you hearing any economic chatter from your side of the industry about like expectations or anything along those lines with it?
Our economists that we have at SWBC said that interest rates will be, in the high fours, low fives by the end of the year. And they've been saying that even before all the inflation. So I think it's here for a while. The Fed has said that they plan on raising interest rates a couple more times. They actually said between 6 and 7 times throughout the rest of the year. But who knows?
Yeah. Yeah. Well, I don't know that anyone really expected the jump to go from the Fed as quick in the month of March as it did. But,
right.
Got to do what you got to do sometimes. So what are some of the challenges that you have seen in just obviously on the real estate side, in the realtor world? The challenges are inventory. It's probably the same for you in many respects, I would imagine. But are there additional challenges that you're encountering on your side?
the biggest challenge right now is on the real estate side is the customers winning the house. I mean, we've got so many pre-approved borrowers that they keep, losing to either cash offers or people putting more money down than they are. So I think it's important for us on the lending side to try and help the buyers remove as many contingencies as possible, make sure they're educated how we can help them make their offer as strong as possible to try and, win a home, because it's really competitive out there.
Yeah. You guys probably have a bunch of borrowers that like compete against each other, right?
It happens. It definitely does when a good home comes on the market, and I'll have 3 realtors or 3 customers call me up and want pre-approval letters because they're making offers on the same house.
Well, it's a win for you, hopefully, maybe. When it's like 40, 50 offers, who knows, right?
It's hard.
So have you ever seen a market like this ever?
I've heard of it happening one time in California years ago.
The 80s time?
No.
Okay.
I was pretty young back then, but no. No, I heard about in California, and where there was a time when things were so crazy out there that a builder would have a new section coming up and people would go and camp out to get in line to buy homes at a trailer in a new development. But I've never heard about it anywhere around here.
Fair enough.
Amazing.
So Nicholas, my bro, is over here on the 1s and 2s instead of Grant today. And I don't know if you remember this. Do you remember a long time ago when I was like hellbent on getting a laptop? I was like 16, and Mom and I went and camped out at Walmart on Black Friday. That's the closest I've come to camping for something.
I joke that the last time I camped out for anything was to try and get my kid into the preschool. So that was like 10 kids for 3 spots, and I had to go there and camp out.
And you're not from here, but you've lived here for
20 years, 23 years actually.
23 years, okay. And you've seen the entirety of this change. Like you've seen Nashville go from not much to what it is today. And now, we're hearing conversation of a couple years from now, maybe, where Nashville real estate prices will hit $1,000 a square foot. Does that blow your mind?
Uh-huh.
Yeah.
And it's kind of scary, because how are our customers going to be able to afford, if we have a first-time home buyer, how is a first-time home buyer going to be able to afford a home in those prices? So
so I think this is where the going out becomes the thing, right? Any big city I've ever been to, the Atlantas, the Houstons, the whatever, they're so spread out, and it all happens for a reason. In LA, I grew up in LA, and it's super spread out, and it used to take my mom like an hour and a half, 2 hours to get to work, and it was only 19 miles. And I like, every time she used to tell me that, I was like, that's bad. But then I've had numerous times on I-24 trying to go from Nashville back to Murfreesboro, which is about 19 miles that it takes an hour and a half.
I remember, again, when we first moved here, Columbia was far away, and then Lewisburg, and nothing was in Manchester. Murfreesboro was extremely affordable. And now you think about, Atlanta and the Loop, and then inside the Loop and outside the Loop. Well, we used to think of being inside the Loop as like being inside the 440 Loop.
I know,
now
it's
the
the
question
840
is,
Loop.
Is the 840 Loop the new Loop? And it's going to be so hard to buy inside the 840 Loop that everything is going to move out. Think about, even Fairview.
Yeah.
That was really far away, and now
it's not. Yeah. Well, and Columbia is exploding, and I've even heard like Lawrenceburg, Pulaski, those are exploding. And it's like, exploding is relative naturally, but Murfreesboro's affordability is not that affordable anymore.
It's going down I-24, Manchester.
Beach Grove.
Yep,
I
exactly.
was talking to somebody the other day who just bought 3 of the 4 exit corners on the Beach Grove exit, and then is also buying another 1,800 acres in Beach Grove. And, you know, it's a hot spot. It's remarkable, but it's so convenient to Murfreesboro. It's not really convenient north, but you know, you get those people who are like, well, I can't afford Murfreesboro because Murfreesboro is starting at, I don't know, at least the 4s, maybe even higher. I know my neighborhood is like, since I bought, now they're starting in the 5s. I bought in the 4s, but I think their sign still said starting in the 3s, right?
I bought a house in Murfreesboro last year, and I thought I overpaid at $250, and now it's a year since I bought it, and I could sell it, you know, for $300 higher. I mean, I would love to find a home for under $300,000 in Murfreesboro.
Yeah, I can't help you with that. I'm sorry.
It's hard. I know.
So, all right. So you've been in this for a long time. You've worked with realtors every day for 20 some odd years. What are some things that you find that the highly productive, successful realtors do? And what are some things, let's start with that question. What are some things that you find that they do? How do they treat the conversation with the borrower, setting you up with the borrower, stuff like that?
Number one, don't put someone in your car until you've talked to a lender and get them pre-approved. And I think there might be a lot of definitions of what is pre-approved out there. I know that
the old pre-qual versus pre-approved.
Right. I think it's an interchangeable word, but you want to make sure that before you go, and especially in this market, if you're driving far, you know, it's so hard to, again, find homes on the market with such limited inventory. You want to make sure that that person is a good buyer. So make sure when I say pre-approved, Dave, the lender has taken a full loan app, gone over their income, pulled their credit. Hopefully, if they're self-employed, looked at their tax returns to make sure that the income they think they made in the previous year was actually what they recorded on their tax return. So make sure that, again, they're pre-approved. After that, you know, then you can go into different ways to, you know, talk to the customer. If you put more money down, you might be able to waive your appraisal contingency. If you put even more money down, can you waive your financing contingency? So
how are those things? How do those correlate with one another? How does putting more money down make a appraisal contingency go away? Or is it just the willingness to pay the gap?
Yes, but there are some tricks to so if a person is a first-time buyer and it was only putting, say, 3% down or 5% down, it makes it more difficult for them to waive their appraisal or for even to waive their financing. But if a person's putting 20% down, why is a person putting 20% down? This is a big trick right here. A person's putting 20% down because most likely they don't want mortgage insurance, PMI. So if they're buying a $500,000 house, putting 20% down, that's $100,000. They don't have mortgage insurance. But what if the house doesn't appraise for $500,000? It only appraises for $480,000. That's okay. What I would do is I would just switch them to, say, 15% down, and they would have a small amount of mortgage insurance, but they would still put 20% down, but I would change in their loan, what's called their LTV, the loan to value percentage would show 15%, and they'd have mortgage insurance, but they didn't have to pay for any gap.
Oh.
So it eliminates that.
Gotcha.
So that's a little trick. Okay. So they don't have to come up with any extra money if they were putting 20% down, but they're going to have mortgage insurance. But if a person's only putting 3% or 5% down, then I can't change their LTV, their loan to value ratio, and they have to come up with, that gap in the appraisal.
Yeah. And so you mentioned the financing contingency is if somebody, obviously we all deal with every situation's different, right? You'll get a borrower who comes in who's a 600 credit score, 3% down, they're borrowing closing costs from a gift from a family member. We've all had that situation.
Exactly.
Then sometimes you get the 780, 20% down, plenty of cash in the bank, whatever. Is there a happy medium there? I mean, it's obviously case by case over and over again, but is there a happy medium with maybe available cash or whatever? And again, this doesn't fall on you as a lender, but is there a comfortable point in which a borrower or a realtor can perhaps advise, hey, let's waive the financing contingency or something?
So waiving the financing contingency is, the buyer needs to understand the legal aspect from their real estate contract. So I'm not a lawyer, but my understanding is that by waiving the financing contingency, it is not waiving your ability to get a mortgage. It's just basically saying that if you don't get qualified or, approved by that lender,
you still buy this house.
You're still buying the house. You can't get out of your contract because of that.
Right.
So again, the risk is always on the buyer, borrower. If they're getting a loan, that might happen. But yeah, I mean, the more money you're putting down, the greater the chance is that there will be a program available for you. And a lot of that burden falls on the loan officer. A loan officer cannot approve a loan. They can't say. So again, you got to have someone who's been doing this a long time. And, the longer they've been doing it, they are going to know if there are any bumps in the roads that might pop up. But short of the loan officer saying, yeah, you're, approvable, you can do something called get a borrower pre-approved for the loan. So basically, you can take that borrower, take all their information. They do not have to have a contract yet. We can submit their information to underwriting and basically say that and get them approved for a loan in advance. And again, the problem
that eliminates so many questions.
It does.
And because you're going to get your conditions and everything right then, at the beginning of the process.
Yep. The problem with doing that is, again, it's how long is it going to take from when they are, quote, approved through underwriting to the time that they find a house? Because if anything changes from the time that they're approved,
right.
if it only takes a couple weeks, the odds are nothing's going to happen. But what if it takes 60 days?
Right.
If anything changes in their credit, if their or employment or any of those variables change,
then you're back to square one.
Exactly.
Yeah. So I don't know most, but many people probably are not going to be aware that you're also a real estate broker. So your depth of knowledge in this industry is far deeper than mine. With that, I had a very specific question, and I just totally lost said question.
That's okay.
And I wish Nicholas had the. Oh, you do have it.
Oh, what?
That's the brain fart button. Oh gosh, and I just did it to myself. That's so funny. When did you have that?
I don't know. I think it got added a couple days ago.
That's hilarious. We've been requesting this button for months because every single time we sit down and have a podcast, one of us, of the four of us at the table, will inevitably have I've got this.
Shoot.
Oh, I just lost this. And so now we have the button and we just got to use it. And it would be so fitting that my little brother would get to use it on me for the first time. So there's that. Good stuff. There was a contract question I was going to ask you about your perception going back to waiving of the contingencies.
Here, this is what I'd say. And again, wearing my lender hat, not being a realtor. So I say, in general, there are 6 negotiable points to a TAR contract. Of course, first is price. Okay. Second is, I say other terms like a closing date, things like that.
Right.
Things that are included or not included with the house. Third is, closing costs. I talk about BC, before craziness, before COVID, in our market, let's just talk about title. I would say 95% of the time that a contract came across my desk, BC, before COVID crazy market, seller paid title. It was usual and customary for seller to pay title. Well, now I'd say 80% of the contracts that come across my desk have buyer paying everything.
Wow.
So that's the third point. So then we get into, a couple of the other, trickier ones, like waiving home inspections. Again, it was extremely rare for me to ever see a contract come across my desk before all of this happened with our market where a person waived their home inspection. And now, again, I'd say, 80% are pass fail, and a lot of them are just, we aren't even going to do one. We'll buy the house as is. But I purposely skipped the last 2, which is waiving financing and waiving the appraisal. So the new TAR contract has the appraisal gap verbiage in there. But before that, I still say customers don't understand how waiving their appraisal affects them. And so have the lender go through very specific scenarios with the customer of, again, if you're buying a $400,000 house and only putting 5% down, what if the house doesn't appraise? They need to understand how much additional money they could be on the hook for if they waive their appraisal. The lender is going to have to do an appraisal. There are some, we'll call them urban legends out there about getting appraisal waivers on purchases. Yes, you can get an appraisal waiver. That's the lender, the mortgage company saying you don't need an appraisal, but that's only if a person has really good credit, not a lot of debt, and is putting a whole lot of money down. And it isn't a guarantee. It's not the lender that's waiving the appraisal. It's Fannie Mae and Freddie Mac saying we don't need one because the people are putting so much money down.
Interesting.
So again, that's the other negotiable point is waiving appraisal, and then you come into appraisal gap problems. I will also say that in the beginning of craziness, which coincides with COVID, housing prices skyrocketed, but there weren't enough closed homes. So the values on appraisals, we saw a lot of homes not appraising at the beginning of the crazy market. Okay. But now we are seeing much fewer homes not appraised because we have so many closed homes. Yeah, exactly. And then the last one is waiving financing altogether. And that just goes back to,
I've always advised if you're going to waive it, make sure you got the cash in the bank to cover it. Because
I think that's, again, the realtor's responsibility, whether it's the listing agent's responsibility. If you're accepting a contract where the person has waived financing, you need to make sure that they have 100% of that money in the bank.
You better get a bank statement or a stock portfolio or something that shows it.
Exactly.
And if you still have that money in the bank after being being down 50, 60% in the stock market, then good.
Exactly.
Good on you. How many of your clients, excuse me, sorry. How many of your clients are you seeing from out of state versus in state?
That's a good question. I mean, 90% in state.
Oh, really?
10% out of state.
You're primarily referral based, right?
Correct.
Okay. Yeah. So are you seeing them go up? So I had a friend of mine over at Channel 5 called me up a few weeks back talking about a story. There was some article published by Redfin about the in-state clients being incapable of moving because out-of-state money is superseding. Are you seeing that with your in-state clients?
Definitely.
Every day?
Absolutely. And I mean, I'm seeing, again, I love Middle Tennessee. I've been here 20 years. All my kids were born here. And I think about, are my kids going to be able to live anywhere near us and afford to be able to live here in Middle Tennessee, because of housing prices have just gone up so much. But the sad part is, so many customers over my 20 years here that I've helped aren't able to, I mean, they're able to sell their current home and make money, but they can't find someplace else to live. And I've had several that are actually moving either out of state to more affordable areas. I've had them move to, out of this area here, Middle Tennessee. I had a customer recently leave Brentwood and moved to Jackson, Tennessee. I love Jackson, and bought like an $800,000 home in Jackson, Tennessee, which that kind of,
it's a big house in
surprised
Jackson.
me. I know.
It's interesting. I mean, the affordability aspect is a significant struggle, and I don't know how it gets fixed, other than local wages going up. But even with that changing, it's going to take a while before people can start to keep up. I mean, you got to think, the house that I grew up in Los Angeles, we rented, and it was a little, I'm going to mess up the stats, but it was probably 1,400 square feet. And in the middle of San Fernando Valley. And I know for sure that houses in that area that are 1,400 square feet are probably about that $1,000 square foot number. They're going to be sitting in that like 1.2, 1.4, 1.6 range. And you've got people selling starter homes. Like literally a starter home in Los Angeles is going to be $1 million, give or take. And yet I talk to my agent friends in LA and I'm like, so what's the market like? Because I know you got a bunch of listings, but do you have any buyers? And they're in the same inventory situation as us. Like there's a record number of people leaving California. Last year was the first time in like the last 70 something years in which California had a net deficit in population. However, there's so many people there who are like, yay, I can finally buy a house, which is remarkable to me. But I feel like we're going to end up in a very similar situation here because, we have all of that money coming in, and they're buying up everything they can or choose to. And we're going to eventually see where the locals can make that kind of transition across town. Hey, instead of being over here, I want to be on this side of town, whatever, and be able to afford it. I just don't know when it's going to happen. It seems like it's probably 10 years from now before people are going to be able to catch up.
It's definitely a concern. And I mean, I'm seeing it in the customers that are trying to sell, make money, and then move up or over, and they can't afford to do it. And so I will say it's creating a new product, which is people staying in their homes, and instead of upgrading, they're doing renovation loans. That's a new product. Yeah. And I'm seeing a lot more people refinancing or, again, take money out of their home and to stay in their home longer, because where can they go?
Which is interesting. So when I started in real estate all 6.5 years ago, I was always told the average length of homeownership is 7 to 12 years. I personally, in the last 6 years, have sold like 6 houses to certain people, like 1 a year.
Right.
Because they could. But I think that was an abnormal that will probably pivot back to the whole 7 to 12 year thing. Do you agree?
Absolutely.
It's interesting to see all that kind of play out. But so Edsel Charles, did you go to Edsel's thing?
I didn't.
Okay. So Edsel had a kind of forecast in which and I did not attend, but in a previous podcast, for anyone who's listening, David Balfour and I spoke about it because he attended on my behalf because I had a meeting. But Edsel talked about how rates are going to continue going up, and then when they hit about 6.5, the market's going to stall. To be expected, understood. But then this was the part, frankly, that kind of excited me. He said after the stall, he expects it to fall back to about a 2017, 2018 market. I loved the 2017-18 market.
That would be awesome.
Like you could actually like go look at a house and like, you know, go to dinner with your family and then send an offer, not like die trying to send the offer before you even like get off the interstate. What do you think? Do you think as interest rates go up, are we going to see the market kind of slow down enough to let inventory kind of catch up, or
Sean,
is local demand going to beat it?
I have access to all of our, you know, the number of loan apps that are being, you know, taken, and it's already slowing down right now. As interest rates have gone up, they aren't really talking about it in the media. Everybody hears that gas prices have gone up and food prices have gone up and now beef, you know, everything is going up. But you don't hear in the media that interest rates are at 5%, you know, or whatever. High
Not yet.
fours.
The media is always about a month behind, though.
Well,
Maybe even longer.
it's catching up to buyers out there when, you know, they got pre-approved 30, 60 days ago. Interest rates have gone up 0.5% in the past 30 days. And
Is there kind of a, sorry to cut you off, is there kind of a standard, like if interest rates go up a quarter point, it affects the affordability of a consumer in X way? Like,
I'm sure there is.
okay. All right. I just didn't know if there was like interest rates went up 0.5%, therefore you can buy a $50,000 cheaper house or something like that correlation.
It's all relative to the price point. So
Yeah.
it has the same effect on, you know, a person buying a $200,000 house. You know, it cut their affordability as it does in the $500,000 price range.
Isn't it crazy? You say $200,000 house and I go, I don't remember last time I saw a $200,000 house.
I don't know where one is. I
Yeah.
don't know where you'd find one.
Yeah. It's wild. Yeah. Sorry. I cut you off. You had a thought. And now we both lost it.
I was going to say, where's that?
Where's that brain fart
Where's the brain
button?
fart button? No, it's interest rates. Back to Edsel Charles. Interest rates. I think it's already happening. I think there's already been a little slowing in the number of applications that we are taking out there. Whether it's, you used a term a few weeks ago, like buyer burnout, I think you said, of how difficult it is. I mean, people are just getting buyers so frustrated trying to find homes. There's such limited inventory. When they do, they rush out there. There's, 30 other offers in there, and they're just getting burnt out on writing offers and losing.
Yeah.
So I think that combined with interest rates going up, and again, if the Fed is talking about raising interest rates 5-6 more times, it is important to know that when the Fed raises interest rates, there's a correlation to mortgage rates going up. But when they raise rates, it's not them raising mortgage rates. Mortgage rates, I always say, interest rates change every minute of every day that the stock and bond markets are open. In general, interest rates are almost like a stock. You can see them going up and down. But when the Fed raises rates, it's affecting everything else. They're trying to slow the market down, and I think it's working.
Yeah. Jeremy Powell, I think he's doing a really good job with it, honestly. There's a lot of factors to throw into the whole piece, but and for anyone who's listening who doesn't know how to look that up, it's the 10-year Treasury Bond, and par value is 2, right?
Yeah.
So anything, if it goes above 2, rates are going, is it inverse? It's inverse, right?
Well, yeah. If the bond is going up, if you're looking at, like, I used Yahoo Finance or Market Watch. If the bond is going up, interest rates are trending up. If the bond is going down, so again, during COVID, The bond went down to the lowest ever. It went down to like 0.5.
Goodness gracious.
Right. So, and that's when interest rates hit the lowest they've pretty much ever been.
2.5s, yeah.
So today, again, I have it up every day. The bond is at 2.4%. And so that's why interest rates in general have trended upwards since their low point in pretty much March or April of 2020. And now the bond is at 2.4%.
So I find it interesting, and I'm glad you brought it up, because I totally forgot that in December of 2019, interest rates were what they are today. We do have very short memories, not necessarily always in our favor either. Because I remember, I think it was September of 19 when interest rates touched into the mid 5s for a minute.
They did.
And the market kind of like, I'm going to sit tight for a sec. But on that note, I believe I saw a NAR report a couple weeks ago that showed the trend of cash transactions versus mortgage transactions, and that it had gone from like 25% of transactions were cash to 29% were cash. So I'm wondering if, as rates flow up, if people are going to say, well, I can't necessarily guarantee in a volatile stock market an 8% return on my stocks. Therefore, I might just go ahead and pay cash for the house and let the appreciation run my cash up. So it might not actually cool off the housing market as much as it appears that it could, by having those rates come up. Because my thing is, the people are going to leave the more expensive places. Tennessee has no state income tax. We do have high state sales tax.
But our property taxes are
ridiculously non-existent.
Low.
Yeah.
It's unbelievable.
Probably too low, frankly. Maybe they should raise them a little bit and fix all those damn potholes. But ultimately, like, the people are going to come from the Californias, the New Yorks, the Illinois, all of those places that are significantly more expensive to live than here. And I heard somebody say recently that the common theme that they hear from those California buyers and others is the extra money that I'm paying to overpay for my house today, I'm going to save in my first year of not paying in state income taxes.
And again, I have family in a lot of those cities, and when they hear that, again, in Middle Tennessee, if you have $1 million house, property taxes, they kind of vary between Davidson County being more expensive, Williamson less, but that property taxes are, let's just say, $10,000 on $1 million house.
Yeah.
It's double that. In a lot of those cities, if not triple that.
Yeah.
And it's unbelievable how much you save. Again, it's why everybody's moving here.
And that's just in property taxes,
Exactly.
not counting state income.
Exactly.
Like, we had some family friends from Long Island. They were paying $70,000 a year in property taxes. It's stupid.
That's insane.
But then you take the income tax, and I know California now has the highest federal or highest state income tax in the entire union. And I think it was, I'm probably off on this, but I remember seeing 18% somewhere. It's a lot to give away 18% of your money there, and then your federal. You're 50 plus tax rate. Welcome to freedom.
I know. Again, it's why, I think a lot of us have had opportunities to move to other places, but once you're here,
yeah,
why would you move? It's great.
Yep. Here, Texas and Florida are booming for a reason, right? So it's going to be, I guess, really interesting to see as interest rates continue to climb. Go ahead.
Well, to your point about as interest rates, so a cash buyer, it doesn't affect them. Interest rates going up. I completely agree. And again, that's more to the detriment of the majority of our customers. If you already live here, you're a family, your family has grown a little bit and you want to go move up, first time move up buyer. Interest rates going up to 5.5, if they go up to 6, like Edsel, you alluded to, it's affecting them. But that cash buyer that's relocating here,
they don't care.
They don't care, and it makes it harder for our customers. And again, that's a concern that I have with that influx of money. We haven't had it to the extent that we do. I'm sure it's always been there, but not in the numbers that it is now.
Yeah. Well, and my thing is, I think that people are going to opt to go cash as opposed to mortgage, because why pay 5-6% against your money, which is already losing, in inflation. It's already lost 7% in the last little bit. So, why keep going backwards? Because there's no investment right now that's going to appreciate the way that real estate's been appreciating. And if predictions of us going from, $400 a square foot in Nashville to $1,000 a square foot in Nashville come true, why not? You're basically tripling your money there,
So, hey, before I forget, have a brain fart, back to paying cash for homes. There is a really cool thing that people can do to pay cash and get a loan. And this product originated years ago because of what happened in California. So again, there was a time in California where, again, probably when the people were camping out to buy homes, that in addition to that, everybody was paying cash and people didn't have the cash to do it. So what they were doing was they were liquidating all of their assets, whether they're paying penalties on 401ks or other retirement plans, to pay cash, and then they wanted to refinance. Well, typically, after you buy a house, you have to wait 6 months before you can refinance when you bought the home. So the government came up with a great program, and I encourage everybody to look into this. Again, I'm not a CPA, but you need to find out the tax implications of withdrawing money out of 401k or retirement funds to pay cash for a house. But the mortgage industry came up with a program. It's called delayed financing. So again, if you can figure out a way to pay cash, liquidate stuff, it has to be your own assets. You can't have gotten a gift for the money. You can't have gotten a loan from some other source for your money. But if you have the cash to do it, you can liquidate all your assets, buy the home to compete with everybody else that's paying cash, and then immediately you can get a loan to get 80% of your money back to put it back into your 401k or other locations that you may have had that money.
Interesting.
It's an awesome program. And again, for some people, if they have the ability to come up with to pay cash, but they would have never liquidated that before, you can get 80% of your money back. So again, that's just like putting 20% down.
Yeah, that's interesting. I remember the first time I did a securities loan for a house. That was interesting too. I have something I want to look up and I want to ask you about it because I've heard a bit of a trend on this.
Again, I think in this economy, this market that we're all experiencing on the real estate and the lending side, it's all about trying to figure out a way to present the most attractive, the best contract possible. I think it's really, really hard for those first-time buyers that need even down payment assistance. Your FHA loans and THDA loans, really tough to win a contract when if you have any competition at all. The other thing I'm then seeing is, so those buyers are then having to buy homes that are less desirable for whatever reason, and then they're buying homes that end up having, inspection issues or, maintenance issues, and now they've got to sink a bunch of money into the homes. It's tough.
Yeah. So there's this thing going around that I've heard from some more of my savvy clients. Oh, man. And part of it is based, there's somebody based here in Nashville that's been pushing it for a while, but it's essentially to pay off your mortgage using a HELOC. Have you heard about this?
I mean, yeah.
What are your thoughts?
It's robbing Peter to pay Paul. There are pros and cons to doing it. And so if you have the equity in your home, you just need to understand. I mean, I love HELOCs and I love mortgages. So the negative of a HELOC is that it is an adjustable rate mortgage. So when the Fed raises rates, like I said earlier, it isn't affecting mortgage interest rates, but it's affecting short-term interest rates. So things like your credit card interest rates go up, but HELOC interest rates go up when the Fed raises rates.
Interesting.
And so it's an adjustable rate mortgage, so that's, a negative, but it's interest only. So it's like getting a credit card. And what happens if you have a $20,000 balance or on your credit card and all you do is pay the minimum payment? Well, guess what? You could pay that for 5 years minimum payment. And at the end of 5 years, you still owe $20,000. You just sat and paid the interest. So it's the same thing on a HELOC. You have to be disciplined enough to be paying down the principal as well. But
yeah, there's this whole thing going around of like, get a HELOC, pay off your mortgage in 5 to 7 years, blah, 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 blah.
Right.
And so
But then at the end of that, you have your HELOC.
right.
So something still has to be paid off.
Same thing, yeah. I don't know if the point is to pay off the house with it and then take the excess and invest it to pay off the rest, but that's a bit of a gamble. To invest with leveraged money
Exactly.
at least not to invest with leveraged money, because you can obviously do that and be very successful. Businesses do it all the time. But if you're going to take $300,000 from a HELOC and throw it in Bitcoin and hope that it goes the right direction, that seems a little risky to me, but it's just me.
High risk,
I don't
high
know.
reward.
Yeah, maybe. So what are some things that you feel that agents should know to do better, to better represent their clients in a market like this from a lender perspective?
Wow.
It's like, wow, that list is long.
Again, you got to go back to those 6 negotiable. Do you agree? 6 negotiable
Yeah.
points. Did I miss one?
No,
I'm sure.
I actually like that because I've never heard that. I've never heard like, here are the 6 negotiable points of a real estate contract. But at the end of the day, it's as simple as that.
Well, I'm not reducing it to that. I'm just saying
No, it's not a reduction. It's just a simplification. I do agree. I also know that there are some, you get newer agents who have never written something, right? They come in here, their client says, well, can we waive this? And they don't know the answers. So they just go, yeah, that's cool. Let's do it. But they don't understand the legal implication of the fact that, hey, if you just waived financing and you just went out and bought a car and screwed yourself out of your financing, you're still on the hook legally for this $400,000 house, whether you want it or not. I think people oftentimes interchangeably use the word contingency with just an automatic out. And sometimes, but there's a paragraph in the contingency generally for a reason. But you work with a few newer agents, and then you also, I'm sure, work with very tenured agents. They all operate differently. Everybody runs their business differently, but I know there are like good habits that people do. There are things that you see. We have conversations in the office frequently of like, what would you do in this situation type of a thing. But like if there was just like one key takeaway from this conversation for a newer agent, maybe they're a couple years licensed, sold a few houses a year, what's something that they should either do that's like a best practice, or something that they should know about from your side of the industry that's a little trick that might help them be more successful?
There is a service that I provide, and I can't speak for the entire industry, but I will say, after doing this for this long, being married to a wonderful wife who understands what I do for a living, where I'm going with this is my weekends are your busiest days as a realtor are typically, Saturday, Sunday, and I say Monday because maybe you look at homes on Saturday, Sunday, and all offers are due by Monday. And so my busiest days are Saturday, Sunday, Monday. There's a service that I provide, and I encourage every agent out there to be, friends, have a great relationship with their lender, and you really want to narrow it down to having a really great relationship with your lender. And before you write a contract, and you want that lender to be there, and I'm not saying I'm there 24/7. You know, whether I'm coaching sports or at a game for my kids, if you need to write an offer, you can call me and I'll say, hey, I'm coaching right now and I'll call you back. But so you got to respect that. But I say, before you write an offer, call your lender and have the customer call them and have them run numbers for them based on the exact home that they're looking at, because we don't know what price home you're going to end up buying. So I might pre-approve someone on 400, but nobody ever writes exactly 400. They might buy it for 19.9 or make up some other number. Plus, what are the exact property taxes? So I work with my agent, go into RealTrax, tell me what the exact property taxes are, because I want to provide I want to dial in my numbers that I'm giving to that customer. What are interest rates? I had a customer yesterday that I had talked to 30 days ago, and the interest rate that I had told them was right at 3.875. So it had already been going up. But yesterday I gave them, and they're like, what? Did you just say 4.875? And I was like, yeah. Based on your criteria, your situation, credit, down payment, that was the rate yesterday. And so, but I ran the numbers for them specific to that house, and then they write the offer. And so there aren't any surprises, later in the process. They knew, here's how much money an estimate of how much money you'll need to buy this exact house. I'll go over appraisal gap. Excuse me. If you want to, waive your appraisal, I'll give them a scenario. If the house only appraises at 380, this is how much money you would need additional if the house doesn't appraise. So I go over that, because if you finally get to a point where you are going to win a house, you don't want the whole deal blowing up, 2 or 3 weeks later when the people don't have the cash to come up with because the appraisal didn't come in.
Yeah, so it's an expectations game. We both live it on different sides. And as an agent, it is your responsibility to set very clear expectations. Also, I would encourage agents out there, anytime your client comes to you with any question that's remotely related to the financing, defer it to the lender. You're not a lender. That was the way I did it all the time. Anytime someone was like, hey, so what should I do about X? Call your lender. And it's like, focus on your specialty, and your specialty is, your depth of knowledge. I'm always blown away. We'll stand around in the cafe here, and it'll be like you, me, and Carlton from Closed Title, and we'll be sitting there talking about like some like scenario or whatever, and you'll just like pull like these, I don't know, you've got a freaking Rolodex of knowledge in there. You'll just like rummage through and find it and be like, oh yeah, I remember that from this situation.
It's from paying the stupid tax. When you do something long enough, I try and help other people not pay the stupid tax. I already paid it. There's something out there that happened before, and man, it's hard to remember all the good deals, because almost every deal should be great.
Yeah.
But you remember that unique, crazy situation where this happened, and you don't want that to happen again.
Yeah. Like the time I had to buy a refrigerator on a deal. Yeah. For somebody. That's the realtor stupid tax. I messed up in a contract.
We all pay the stupid tax.
What are you most excited about in the future?
Every day I wake up and I'm super excited to go to work, and I love helping people, and I'm a really competitive person. So what am I competing against every day? Man, I always joke and say I'm competing against the evil rules makers. That's the government that makes the rules that regulate my industry. My goal is why do I come and do this for 20 years? And every day, I love it, Sean. Yeah. It is so fun.
No, you're always here before me, and you're always here after me. Shame on me.
So you never know what tomorrow's going to bring. And there's always I get to help people. It was so exciting. Last week, I went to a closing of this girl. Not only was she a first-time home buyer, but she was the first person in her family. Her mom never owned a home. Her grandmom didn't own a home. And
that's awesome.
That's what we do.
Yeah.
And to have the passion. And for me, I have been on the real estate side of things, working for a builder, being a realtor, broker. But on the lending side I go to those closings and I see those people and I'm helping them. And it was a challenge to help her get it. And so to me, every day brings some new scenario where I get to help someone figure out a way to buy a home. And even if it's not the first time home buyer, I love the first time, but the investor, how can I help them figure out a way to increase their, return on investment? So that's my competitive nature is every day.
If I was a loan officer or transitioned into being a loan officer, I'd want to shadow you and learn from you because your experience, the experience that you have is significant. And the passion that you have, literally the fact, sometimes I can't even get a word in because you're on the phone literally from the moment you get here to the moment you're walking out the doors. I would almost challenge you that Wednesday I was on the phone more than you, but on Wednesday I had 20,000 steps and 46 phone calls walking around in my living room at my house while I had no voice. So and I'm sure you had more than that, but that's fine though. I beat you on steps though, I bet.
I walk around and talk.
Yeah,
on
you
my
do.
headset.
You do. Usually to have a Nerf gun fight briefly.
Exactly.
So, all right. So how many families or individuals were you able to help last year?
Last year we in the mortgage industry were blessed with the
Oh,
most
the refi
ridiculously
boom.
low interest rates ever. So all those people, so you pretty much refinanced your entire pipeline from a year and a half ago. So all the people that bought in 2019 that had interest rates in the 4s, touching 5 towards the end of 2019, right before COVID, every one of those people refinanced. So
last year's an unfair comparison.
2020 and 2021 but I have built my personal business on referral business, working with realtors. The purchase business is what you live for, and refis are just, a bonus, I guess. But so, me personally, I probably about 15 to 20, 20 people a month is on the purchase side is 20 families.
It's fantastic.
20 people.
Yeah, that's awesome. To be able to directly impact the lives of 240 individuals or families throughout the course of a year is awesome. Because most people don't have that opportunity.
And Sean, every day, and I see those people. I live here, and again, I have a bunch of kids, and I'm out at sports events, and I see people. I was at a soccer game Tuesday night and saw someone. He's kind of looking at me, and I couldn't place him, and I realized, oh yeah, I did a loan for them. We were playing Independence High School, and oh yeah, he bought a house, and that's how I know him. He was smiling at me, and I'm like, it was someone that I had done a loan for.
That's
years
awesome.
ago.
That's awesome. All right. So if anybody needs to call you for loan questions, advice, or pre-approval, how do they find you?
615-405-3894. I've had
Sweet.
that number for 20 years.
615-405-3894. You can reach Lippe, and we all call him Lippe.
That's fine. I've had that name for a long time.
For me, everybody used to always call me Miku because, baseball. And now nobody can even say Sean correctly. They normally hit me with Scene. But I think that'll wrap it. Thank you so much for being on the show with us today. And we'll have to do it again as the interest rates saga continues. Thank you guys for tuning in. Feel free to click the like, subscribe, comment buttons. You can find us on YouTube, Spotify, Apple, anywhere podcasts are. Please support us. We love being here, chatting with you guys every single week, and we will see you guys next week.
Hey guys, it's Swy. Thank you for joining us this week, and we really hope you got some useful information and we made your day a little bit better. If you're interested in joining the movement of realtors getting their time and life back, check us out at joinsimplihome.com on the browser, at simpliHOM on socials, or in the description. See you next week.